Good morning. Welcome to Forex in Four. Today is Wednesday, November 16th, 2011. Alrighty, we are starting out here with the pound, and as you can see, it's been on a nice little slow decline here. I'll show you the 30-minute chart, but we're going to back this out a little bit to the 2-hour. Okay, and you can see that we had set up, well, let's back it out a little bit further to the 4-hour. So you can see where this range has really been set up, and we've identified this range previously, and once it broke it down at 159, it just sort of, headed off to the races. Now you can see here that this 157, say 60 area, 65 area, is the daily S1 pivot support. And that looks to be holding right now, but we're in a situation now where this has just been like an old, stock market adage. But it's you say you buy the dips and you sell the rips, and that's essentially what's been going on in these markets. All right, is that we see that overnight in Europe we have all of this risk aversion going on from what's taking place there, from the debt crisis to slowing economy. All right, and you see this selling off going on, this risk aversion happening. All right, and then we open up in the U.S. session. And as soon as we can get past Europe and European session closes, market goes into rip mode, and I'll show you that in a second. But right now we're looking at the pound here for a couple of reasons. All right, first is that they had the unemployment report came out, and it ticked up higher than expected. All right, they were expecting it to rise to 8.2% from 8.1%. All right, and we actually got 8.3%, so it ticked up a little bit higher than that. They added 5,300 jobs. They were expected to have added 21,000 jobs, so that was a big miss there in the UK. Also, they had their inflation report, and they came out and they said that they expect inflation and CPI data to be back to under 2% within 2 years. Well, I mean, that's going to show a drastically slowing economy, right? Because yesterday they just reported 5% CPI. So they're expecting that to come down quite a bit. So they're talking about further, monetary easing, further accommodation, and further stimulus. All right, which means if they go pick up quantitative easing to perhaps combat the effects of the European debt crisis, then we could see the pound weaken dramatically. All right, so that's what we're looking at here with the pound, and you can see the situation there. But let's head over to the euro, okay, and you'll see the same thing with the euro. Okay, euro moving down. All right, and you can see this activity here. All right, here's yesterday. Okay, during the European session. This is the U.S. session, goes sideways, and then all of a sudden, boom, right to the close of the U.S. session, sells off. We get the bounce here once they're closed in Europe, and then boom, we start the resumption of the selling. So you can see sort of how this pattern's been emerging, and that's why I say buy the dips, sell the rips, because this is not a trending market. We're talking about a wide range bound activity, and this is pretty much the case just about everywhere. So you have to be willing to take both sides of the trade, all right, and just be nimble with it and be quick. So that's what we're looking at with the euro. I guess, well, let me go back to the euro. Let's talk about what's happening over there. So now, the bond yield issue is coming to a head. We're talking about problems with the new governments, perhaps. The new guy in Greece is already going to hold a confidence vote. We'll see how that goes. The politics is already starting to pick up in these places, and it's going to be interesting to see whether these new technocratic leaders are going to be able to rally support, or if it's just going to be business as usual in both Italy and Greece. Now, they also had some news out this morning. We can look at their what was it? Their CPI data came in as expected, so not a big deal there. But really what everyone's concerned about is the debt crisis. And we've seen the ECB has stepped in. They've been buying some of these bonds as the bond vigilantes just sell, and cause yields to rise. All right, but they're not doing enough here. Okay, they haven't put in a threat to the market that's going to give any bond vigilante any sort of fear that they're going to step in. So the move right now is to sell, drive yields higher. As yields go higher, becomes harder to refinance their debt. Boom, contagion problem, crisis, and it goes downward from there. So Europe really needs to get it figured out. We're also going to see what's happening here in the U.S. with CPI data. All right, we're expecting a 2.1% ex-food and energy, 3.7 headline. I got to tell you, the inflation story that we're seeing, all right, these guys are just nuts with what they're trying to do here. All right, let's face it. All right, things cost too much. All right, I don't care, where you are in the income scale, whether you make a lot of money or you make a little bit of money, stuff costs too much. That's why you see the rise of all these discount sites, Groupon, Guild, Living Social, all this stuff, right, which is intended to get people to consume But the problem is stuff costs too much. All right, we've got this housing market problem, which is nobody's talking about. We're in economic stagnation, and we've got this debt ceiling debate happening. And right now, look at this. What are we looking at? We're looking at oil. Look at what's happened. All right, we had this euro crisis going on, and oil's just going higher. Well, all right, we're talking about why are oil prices going higher? Well, perhaps it's because of what's going on in Iran. All right, that's been a story that's been floated, but I got to tell you, it's also inflation. All right, we're going to see deflationary figures from last quarter. All right, stuff was priced lower then, but guess what? Come next quarter, I think we're going to see a pretty big pickup in inflation, especially the headline figure, not the ex-food and energy that everybody likes to look at. So things are costing more. All right, unemployment's high, which means a lot of people are out of work, which means they rely on the government coffers. All right, whether it's their fault or not. And, these guys are just printing money here to try and get this thing going, and it's not working. So this is a disaster. But look at oil prices, just under $100 a barrel. Yet we're seeing, all these inflation figures. CPI data, 5% in the UK, 3.7 we're expecting here in the US, 3%, all right, in Europe. And everyone's saying, no, everything's, we got to get prices to go higher. I mean, are you kidding me? This is insane. An area where you can see a little bit of deflation happening is in the Aussie. All right, they actually had their wage figures come in, and this one, the wage cost index, is it's not a high priority number that most people look at. All right, but it came in lower than expected, showing that they've got a little bit of wage deflation happening. Well, if that happens, you can see deflation across the board, which means that there's room for the RBA to cut rates further. So we're going to keep an eye on the Aussie as well. Lastly, just show you JPY. All right, you can see just a gradual strengthening happening. All right, they had the interest rate decision overnight. They didn't do anything there, left it at 0.1%. That rate's been there for as long as I can remember. All right, but they didn't leave any clues about any further intervention that they may take. So, I got to tell you, it looks like the market's just dipping their toe in the water and just strengthening, just to see how far they can push here before these guys intervene again. But, this chart pattern, all right, I called this yesterday, but it looks like you can see there's a triangle in here, right? If we just measure that into that, and a lot of times is that, depending upon how far this thing can go, all right, if we get back to maybe the 76.50 area, all right, they might step in and intervene again and try and shoot it up towards 80. All right, so they're just huffing and puffing on this thing and trying to get people out, but everyone's running to it because of the flight to safety trade, all right? Everyone's afraid of what's going on in Europe and that we've got this contagion happening and that they're not doing enough to get it figured out. So a lot of problems in the market, a lot of fear that's out there. But again, I'm going to come in and say it. Let's look at the S&P here, and you can see this from yesterday. Okay, the idea is buy the dips, sell the rips. All right, we look at the 1 hour chart, and you can see, boom, S&P going down. Afternoon trade in the U.S. into the overnight. European markets open, goes down. All right, afternoon trade in the U.S., boom, right up again. Oh, European market open, sell it off. Well, look right here. All right, on the 1 hour chart, you got a little bit of support down here. Say 1235 is just a round number, not too significant. But if we back it out a little bit, all right, you can see this range here, 1225 is actually probably a little bit better support. So, you can see how this activity is happening. You can see that this range is narrowing. So, if you're a longer term trader, you've got to take appropriate action, all right? There's no trends emerging right now, all right? Maybe, you want to buy down here, hold on for a while. Maybe you want to sell up here for a while. It's hard to say, but right now the move is trading the range. So that's what I'm going to continue to do. Unfortunately, the trading's been on shorter terms, which means you have to act nimbly, which means that sometimes it's hard for me to put up these trade alerts and get them out to you as quick as I'd like. So in any event, just do what's been working, and that's trade the range. So that's what I've got for today, folks. Good trading to all.